trying to reconcile these two things, because it seems like the bond market is really almost yelling at us in one direction, that we're really going in a not good place. But there are other indications, particularly retail sales today, that seem to go the other way.
Yeah, well, thanks for having me. Well, I think the conclusion here that I would draw is that the retail sales print today was really strong, but I think it overestimates the underlying trend in the U.S. economy. So I think there were some special factors in July that probably boosted the retail sales print, including Amazon's Prime Day, which has resulted in broader promotions from Amazon's competitors. So what we've seen in recent years is you get this bit of a surge in July, but it's actually consumers that are, pulling forward these purchases. So they're purchasing things in July that they would have purchased in August, or even in September. So I think that, although it's a strong indication, good indication, I think it does overestimate, the ultimate underlying trends in the U.S. economy right now.
So maybe,
and that's what the bond market is reflecting.
Okay, exactly. But maybe the retail sales are overestimating to the positive side. Is the bond yield curve really estimating to the low side? I'm going to put up a chart here. You know it well from the New York Fed, where they do an estimate of the probability of a recession within the next 12 months. It's up above 30% right now. Since 1967, every time it's been above 30%, we've had a recession. Is this an accurate portrayal? Are you watching things like that?
Yeah, absolutely. So as you suggested, the yield curve has been a really good predictor, leading predictor of recession. And ultimately, how we're interpreting it is that the recession risks in the U.S. economy, as well as in other global developed markets, have increased, and so therefore the market is right to price in that higher probability of recession. I mentioned that there are certain sectors of the U.S. economy that are very weak right now. Those sectors tend to be related to manufacturing and global trade. Data out of Europe and out of China also has been relatively poor. So really the question is does that weakness start to spill over into the other sectors of the U.S. economy that have been relatively strong, like the consumer? And I think what's worrying markets more recently is we've started to see early indications of that. So how that sort of spills over is through labor markets, and labor market momentum has started to slow. Businesses what they start to do is they first start to cut back hours and moderate the pace of job growth, and we've already started to see that. Although we haven't started to see separations pick up, actual firing of workers pick up yet, but we're kind of in those early stages of a slowdown that really start to concern you.